Welcome back, everyone. This is going to be distribution planning continued. We had just put out some videos in the last few weeks about planning your distributions from your retirement. But now we want to talk about all the ways that you can distribute in terms of coming up with cash flow in retirement. So there's three main categories of investment accounts. The first main category is going to be taxable. Taxable over there on the left is going to be investment accounts that don't reside in a retirement account. These are investment accounts that are brokerage accounts, stocks and bonds, mutual funds, even bank accounts. These accounts get taxed in the year that income, interest, or capital gains are earned, and you will pay taxes every year as you earn money. Okay? Over here in the middle category is what's called tax deferred. This is going to be your thrift savings plan, traditional. This is going to be 401ks and 403bs that are traditional, as well as IRAs that are traditional, and annuities. These are before tax money, and they are taxed upon withdrawal, okay? Over on the far right is going to be your tax-free buckets. These are your after-tax accounts that grow tax-free in perpetuity over you and your spouse's life. In addition to that, your children or beneficiaries have 10 years in terms of tax-free growth where they can prolong the receipt of that money and continue that in a tax-free Roth vehicle. These are Roth TSPs, Roth IRAs, life insurance. So these are the three accounts, right, that you can utilize. And so what we want to think about is what order, right? What order do these accounts get used? So if we look at how they grow, we can figure out how we should spend them first. So if we look at the light blue column here, okay, the light blue column is going to show you the taxable column, okay? And so the taxable area that we talked about, which is your investment accounts that get taxed every year, if you're at a 20%, 28% tax rate, it's going to curb the growth of that account because you're paying taxes as you go. So that account, even a $100,000 account, is not going to have the type of growth that a tax deferred account is going to have, which is your traditional retirement plans. And of course, not the same growth rate that your tax-free Roth accounts are going to have, because not only do you not pay taxes at the end, like a tax deferred traditional plan, you don't pay taxes at all. You don't have tax on dividends or earnings, capital gains. You don't have taxes on withdrawals. It is the holy grail of tax planning in terms of investments. So then where are we going to withdraw first? Well, we're going to withdraw out of our non-retirement accounts first, okay? Because that's going to grow the slowest because of the taxation. And the pitfalls that we see, all right, for folks that are in retirement is they don't know the correct order. So here's the correct order. We're going to use our accounts that tax us every single year, which are our outside investment accounts. We don't want big, heavy dividends. We don't want big, heavy capital gains. So we're going to use those first. Then we're going to follow that up by withdrawing from traditional tax deferred accounts next. We want to spend those down so we don't get hit with required minimum distributions, RMDs, in our mid-70s. And that is going to allow our other most coveted retirement account to grow, which is your Roth. We want those growing tax-free as much as possible so we can utilize those in emergencies, right? We can utilize those in emergencies, and we can let those puppies grow as much as possible, because that is where we're going to be able to create generational tax-free wealth, okay? Now, before I get out to the generational tax-free wealth, look at the difference that can make in your lifetime. Okay. So the benefits of using assets in the correct order can literally make the difference between someone that was going to run out of money right before 90 years old or someone that is going to extend their investment vehicles past 90 into their mid 90s just on where they're taking money. So again, folks, we stress not every size shoe fits all. All right. There are certain times where someone is in such a low tax bracket that I recommend to use tax deferred investments first, right? Just had someone that was in the 12% bracket where I was utilizing that strategy simply because they were going to go into 22% when they were 73, when their RMDs began. So for them, we're going to utilize some retirement assets first and some Roth conversions, right? But it all depends. So if this is something that you're truly concerned about and want some discussions on, scan the QR code in the bottom right. That's going to take you right to our one-on-one sign-up meeting, and you can have a 1-hour session on Zoom with us so we can discuss which strategy is appropriate for you. But 90+% of the time, it's going to be taxable accounts. That means non-retirement first, tax deferred. That means traditional second, and Roth last. Thank you guys for listening.